There is a strategic perspective on Wall Street that suggests if everyone is talking about the same retail opportunity, then the institutional smart money has likely already moved on. At this moment, while mainstream financial media remains heavily focused on daily inflation updates and tech sector volatility, market data indicates a significant, quiet shift in global capital allocation. Evidence suggests that major institutional players and large-scale wallets are increasingly rotating their capital into specific tangible assets and capped digital commodities, executing these strategies away from the retail spotlight. Welcome to this deep dive into current market cycles and global capital flows. If you view the global economy as a series of random events, or believe that asset prices move purely on casual sentiment, the underlying data might surprise you. Today, we will analyze the latest on-chain metrics, examine the strategic positioning of billion-dollar institutional portfolios, and track where liquidity is actually moving in the current macroeconomic environment. Stay tuned until the very end to understand how these structural market shifts could impact your long-term wealth preservation. Where is global liquidity flowing right now? Macroeconomic indicators suggest a growing sense of caution among major financial institutions. While the Federal Reserve continues to manage interest rate expectations, a structural shift is visible elsewhere. According to recent World Gold Council data, central banks have purchased around or above 1,000 metric tons of physical gold in recent years. This persistent accumulation strongly implies that global monetary authorities are actively hedging against systemic fiat currency depreciation and long-term inflationary pressures. Is traditional gold the only hedge in the digital era? Institutional data suggests otherwise, as Bitcoin increasingly functions as a digital alternative. Behind the volatile headlines and media skepticism, on-chain metrics reveal a distinct pattern of accumulation. Data indicates that a substantial share of Bitcoin's circulating supply is held by large-scale, long-term entities, often classified as whales. This persistent holding behavior suggests that large-scale investors are anticipating a structural supply shock, especially following the recent halving cycles and the deepening liquidity of spot Bitcoin ETFs. Some market analysts point to a striking divergence in how major Wall Street funds interact with different investor classes. While retail capital is heavily encouraged to chase high-multiple, heavily hyped artificial intelligence and tech stocks at historic valuation peaks, net inflow data tells a more nuanced story. Public filings show that institutional giants have integrated digital assets into their core portfolios, with spot Bitcoin ETFs alone capturing tens of billions of dollars in cumulative net inflows. This dynamic suggests a strategy of shifting retail attention towards speculative equities while institutions quietly accumulate scarce, foundational assets at lower cyclical points. To successfully navigate this environment and protect your portfolio, it is essential to comprehend this ongoing smart liquidity rotation. In several markets, capital has increasingly rotated away from long-term sovereign debt and traditional cash, seeking refuge in assets with absolute mathematical scarcity. Whether you hold equities, digital assets, or cash reserves, tracking institutional fund flows is a highly reliable metric for risk management. Relying on actual capital placement rather than media commentary is often the definitive factor in wealth preservation. In conclusion, the global financial landscape rewards those who ignore market noise and analyze institutional data with cold logic. The most capitalized market participants consistently thrive because they adapt to structural cycles and position themselves alongside major liquidity trends. If you found value in this data-driven analysis, please support the channel by hitting the like button and subscribing. Your support allows us to continue delivering objective, institutional-grade market insights. Think like a market maker, manage your risk intelligently, and we will see you in the next report.